Hey y'all, this is 11.2 bonds and other financial assets. So, bonds are basically loans. Investor must pay. Oh, heck, there we go. Bonds are basically loans. The issuer must pay back the investor. So, yeah, investors pay a fixed amount of interest. So basically, what this is the issuer will pay person pay back the investor, because bond, what they did during World War II was the government needed more money, so they started giving bonds. So people would go out and buy these bonds, and it helped it helped the government make money for the war. And then after a while, the government paid them back after the war, and after they had enough money to do that, pay them back. And then the investor, which is the government, pays fixed interest on it. So you can hold a bond for 100 years, and if that bond was originally $50, depending on the interest, it could be 100,000 in 100 years. So yeah, bonds are pretty nice. And then the three components of a bond are: coupon rate is the interest rate that a bond issuer will pay to a bondholder. That's basically just the interest, checking accounts, saving accounts have an interest, but bond interests are generally more. And then the maturity, the due date of a bond, usually 10 to 30 years after it's issued. So if you buy a bond in 2000, it has a fixed amount of time so that you can have that bond. So if it's 10 years, the government will have to pay you back with all the interest in 10 years. So, and then or whoever issued the bond will have to pay you back in 10 years. And then the par value, the amount that's supposed to be paid back at the end. So that's including the interest that were collected and the original amount. So yeah. And then buying bonds at discount. Issuer sells bonds for less than par value if the coupon rate is lower than average in the market. Okay, I just keep forgetting to go to the slides. Example: market $1,000 par value with 6% interest annually. So basically, if the par value is less, Okay. The different types of bonds. Savings bonds are generally the lowest denominations of bonds that you can get. They're generally range from $50 to $10,000, and they're bonds issued by the government. And then treasury bonds, right here, offer different lengths of maturity. So treasury bonds, you can get up to 100 years on those bonds, so they're just the longest lasting bonds. And then bills and notes, and then they're backed by full faith and credit, which means if the bank or whoever you loaned or got that bond from, if they go out of business and they can't pay you back, the government will. So the government will pay you back the amount. And then municipal bonds are bonds issued by the government to fund public projects. So in Sydney, how they're building all these new buildings out here for the road stuff things. Yeah, out in a town, which they already have done. They just love spending money. Okay, and then corporate bonds are pretty much there was a car company, I forget which one, but there was a car company that went bankrupt, and the government bailed them out. So that's pretty much corporate bond. GM, yeah, that one, GM. And then junk bonds are bonds with fairly high risk of default, which means going away and not making any money, sometimes losing money, but potentially high yield. And then other types of financial assets: certificates of deposit, one of the most common forms of investment. Banks lend funds deposited in CDs for a fixed amount of time, such as 6 months or 2 years. And companies like doing this because they have a higher interest rate than a normal just checking or savings account. So, and if they have a lot of money that they aren't gonna plan on spending, they generally put it on a CD because they'll make a lot more interest on them. And then money market mutual funds are a special type of mutual fund. Intermediaries buy short-term financial assets. So like, if you want to buy a house and you only plan on having paid off for like less than a year, and then investors receive higher interest on a money market and then on a savings account, and MMM funds are not covered by FDIC insurance, unlike savings accounts, so you can lose all of your money on them. And then the financial asset markets are capital markets, markets in which money is lent for periods longer than a year. Money markets, markets in which money is lent for periods of 1 year or less. Primary markets, financial assets that can be reduced only by the original holder. And then secondary markets, financial assets that can be resold by anyone. So yeah, fun fact. And then here's your vocab. So, and then just pause the video here to get this slide vocab. And then we have this slide of vocab once you're done. This slide vocab once you're done with that. And then you can pause the video here as well. And then once you get that down, we have this slide of vocab. So, and that's it. So yeah.
It's not exact.